Let me discuss the risk uh, of overvalued growth stocks and how to avoid them. The risk inherent in investing in overvalued growth stocks and how to avoid them. So in this context, I want to start with my introduction. Number one, growth stocks can offer high returns, but they also carry the risk of being overvalued, especially during market booms. They have that risk of becoming overvalued. So overvalued growth stocks may appear attractive, due to their potentials, but they can lead to significant losses if market expectation, don't materialize. The market believes these stocks will keep on growing in a stage where the stocks, are no longer growing as expected. The market may become discouraged and then they will dump their shares and the stock may sustain, uh, inevitable losses. Number two, understanding overvalued growth stocks. Understanding overvalued growth stocks. Overvaluation occurs when stocks market price is higher than um, than um, than um, than its intrinsic value. When a company's price is higher than what it is worth intrinsically. So often driven by high investor expectation rather than the company's fundamentals. They are driven by, investors' expectation, rather than the company's, fundamental performance, rather than the company's, fundamental health. So growth stocks are particularly susceptible to overvaluation because they are priced based on expectation of future earnings projection, which are uncertain. Nobody can precisely predict the future. So that growth is based on future expectation, which may or may not come to pass, which may or may not materialize. Number three, signs of overvalued growth stocks. Signs of overvalued growth stocks. A typical example is it has an extremely high PE ratio. It has a high, price to earning ratio. A price to earning ratio significantly higher than industry peers or historical norms can signal overvaluation. When the company's PE ratio is higher than what is obtainable within the sector, then that company is considered overvalued. So growth stocks often have a high PE ratios, but when they become excessively high, it may indicate that the expectation surrounding the stock is becoming unrealistic. It cannot be realized under normal circumstances. And so there is a lack of profitability. Another sign of overvalued growth stock is lack of profitability. Many growth stocks don't generate profit early on. If a company is consistently losing money without a clear path to profitability, its stocks might be, inflated. You see company with zero profit, but they keep on generating, growth. That company may not, continue to grow further. It might sustain losses in the future. These, sky high price to sell ratios. The price to scale ratio is relatively very, very high. A high price to sell ratios suggests that the stock is priced much higher relative to its revenue, often indicating that the market is overly optimistic. It's overly optimistic when it comes to the company's prospects. There is excessive market hype. The company generates excessive market hype. A stock being heavily promoted in the media or among retail investors, especially in the absence of strong fundamentals, can signal overvaluation. There's no supportive fundamentals and the stock is highly promoted and the price keeps on increasing, the stock will end up becoming overvalued. Not only that, there's an unrealistic growth expectation. Unrealistic growth expectations. When investors, expect exponential growth in the future without considering economic conditions, or competitions, the stock, price may be inflated beyond, reasonable expectations. Please like this video and subscribe to this channel. Number 4, the risk of overvalued growth stocks. The risk of overvalued growth stocks. There's sharp price decline. Sharp price decline. When market sentiment shifts or growth expectation falls short, overvalued stocks can experience steep declines, wiping out substantial amount of wealth. Generally, whenever there's a steep decline, you discover that the company would the investor would lose a substantial amount of wealth. Then there's a bubble formation. Bubble formation. Overvaluation can lead to market bubble where stock prices become detached from companies' fundamental value, eventually busting when investor enthusiasm wane. Investors will not remain euphoric or optimistic forever. Discover that at a point in time, the excitement will wane and the stock price would nosedive. Then there's opportunity cost. Opportunity cost. So investing in overvalued growth stocks, means missing opportunities in other undervalued or reasonably priced stocks that could provide, better long-term result. When you buy a growth stock, there's an opportunity cost involved. You could buy a better value stock somewhere. That's something you need to take into consideration. Then there's increased volatility. Overvalued stocks can be more volatile, reacting sharply to news, earning reports, or changes in market sentiment. They tend to react faster than normal, faster than average when it comes to news, when it comes to earning reports, when it comes to changing, changing, investor sentiments in the markets. Number 5, how to avoid overvalued growth stocks. How to avoid overvalued growth stocks. You should focus on fundamentals. Focus on company fundamentals. Look at key financial metrics such as PE ratios, price to sales ratios, and earning growth. Ensure that the stock price is justified by its financial fundamental performance, not just speculation, about future expected growth. No, focus on fundamentals. Don't focus on future growth expectation. Not only that, compare with industry peers. Make comparison with other stocks in the same sector. So compare the stock valuation to that of other companies in the same sector. Even the stock valuation is significantly higher without a clear reason, it might be overvalued. The stock price is higher with no underlying supportive reason. In that case, the stock price is considered could be considered overvalued. So be cautious of excessive hype. Be cautious of excessive hype. Avoid buying stocks based solely on hype or social media trend. While hype can drive short-term gains, it can also lead to overvaluation, and a sharp correction, when the hype fades. The hype cannot continue forever. At a point in time, the hype will fade, and the stock will undergo correction, which will certainly cause the price to plummet because it was hyped to a level of overvaluation. Then you look for sustainable growth. Look for sustainable growth. So in this case, ensure that the company has a clear path to growth, including a competitive advantage, a proven business model, and the ability to scale profitably, ability to expand profitably. And not only that, you also need to diversify. Don't put too much of your portfolio into high risk, overvalued stocks. Diversifying across different sectors, including growth and value stocks in your portfolio, is the way to go. You may consider, other asset classes that can help mitigate risk of investing in overvalued stocks. Then you use some valuation tools, utilize valuation tools. You use tools like discount cash flow, model or analysis, or earning growth models to assess whether a growth stocks, whether a growth stock's current price and is supported by the company's fundamentals. Is the current price actually supported by fundamentals or not? You use these tools to be able to analyze and arrive, at a dependable conclusion. Number 6, market timing and patience. Market timing and patience. Why it's hard to time the market perfectly, being patient and waiting for a stock to become reasonably priced on reasonable. If you wait for the stock to become reasonably priced, then you can reduce the risk of buying overvalued stock. Just be patient and wait for the price to come to a reasonable level. So in that case, you end up buying, at at an acceptable price, at a price that is not considered overvalued. And you also wait for pullbacks. If you identify a stock you believe has strong long-term potential but is overvalued, wait for the price to pull back, to enter a more reasonable, attractive level. So be patient, wait, because the price will not be overvalued forever. The company will not be overvalued forever. Eventually, the price will drop, and when it drops, it is the right time for you to buy.